The short answer is yes, we think so. The tech segment is looking quite expensive. The valuations of a number of mega cap growth stocks just appear too demanding right now. For example, Amazon and Netflix are trading at around 60 times its estimated earnings over the next 12 months, while Microsoft and Apple are trading above 30 times. The stellar performance of tech this year means that the 6 largest stocks in the S&P 500 now account for around a quarter of that index. If we exclude these 6 companies, the S&P 500 is actually down year to date, illustrating the divergence in valuations between tech and the rest. Now, 11 million fewer people are employed in America today than back in February, and this is more evident in the prices of stalwart companies like Coca-Cola and Goldman Sachs, which are both down around 7% so far this year. Now, of course, there are clear arguments to be made for these tech giants to trade at higher multiples than the rest of the market, but we simply think that the extent of the gap has shifted the risk-reward balance away from tech towards the less favored segments of the market. The key reason for the outperformance of global tech so far this year is that these companies are growing their earnings through the pandemic, while other businesses will see lower profits in 2020. It's clear that the pandemic has served to accelerate the world's transition to digital. From consumers buying more products on Amazon and spending more time watching Netflix, to businesses making far greater use of cloud computing technologies as people work from home, we've seen around 3 years worth of digital progress in the 6 months since March. At the same time, old economy company earnings will likely only return to 2019 levels in 2021 or 2022. So the market is clearly willing to pay for the greater visibility of tech earnings. But we do remind clients that no matter how predictable a company's earnings may appear, it is only a good investment if you buy the shares at an appropriate price. Now, to help economies deal with the pandemic and resultant job losses, global central banks have provided extraordinary levels of monetary stimulus in the form of low interest rates. They've also made it clear that these low rates will be around for some time to come. These low interest rates then mean that investors are searching for yield away from government bonds, and that lowers the required return for equities as a whole. US government bond yields are down about 1 percentage point since February. So from that, the rise in the S&P 500 would appear reasonable if it weren't for the fact that global GDP has taken a major hit, and this will undoubtedly drag down corporate profits. Recent sharp correction in tech shares also shows that the market can move much quicker than investors can react. And this is why in our global portfolios, we've remained true to our valuation-driven philosophy and have trimmed some of our more expensive tech exposure over the last couple of months, switching rather into less fashionable names. Now, only time will tell whether we've timed this correctly, but we maintain our view that over the investment cycle, valuation will trump fashion.